Hi everyone, this is Craig, the options linebacker, and this is the weekend report for Sunday, February 14th. The past 4 weeks it's been really tough to be a trader. Not only have we gone from a period of acceptance and euphoria in the market and absolute and total complacency now to a period of disgust where people just don't trust the market, we're also being assaulted on all fronts right now by all of the negativity, all the negative news that's out there, and then people trying to take advantage of the situation, and frankly trying to scare you half to death just to get their services. So the problem here is that this little blip that we have, where stocks have sold off for the past month or so, is all too familiar to us. We've all been through this crash what we had in 2008, and this is just too close to our memories. So after seeing 11 months straight up, with no pauses, no breaks, just straight up, now we have a few weeks to the downside, and it's just too familiar to us. It's just too close to home, and it reminds us too much of those panic days that we had back in the fall of 2008. So this is when we have to block out all the noise and ignore all the pundits and everybody, including me if that's what it takes, and just look at the charts and let the charts tell you what's going on, because they will never ever lie to you. So let's start off with the S&P 500. We have the monthly chart on the left hand side. As you can see, the big rally off the bottom, and at some point we knew we were going to have a lower high. It wasn't going to just go straight up here. At some point we're going to print a lower high. This is as good a place as any, which is close to that 61.8% retracement and just over the 50% retracement at around 1120. In fact, we covered this in a video a few months ago, but we looked at a lot of the crash scenarios from the past, including 1929 as well as the last recession that we had back in 2000 to 2002. And we found that the initial bounce off of the crash came up about 50 to 55%. And then from there, one of two things happened. It either went sideways for a while, as in 2003 to 2004, and then started heading higher. Or in the case of 1930, it just started to sell off and we had well below a double dip. But frankly, I'm not going to try to predict whether or not we're going to have a 2004 type recovery where it kind of goes sideways before it starts working its way higher again versus a 1930 double dip. I don't know, and nobody else does know what's going to happen in the next year or so. You can read the news and try to predict that, but how well has been reading the news been working out for you so far and trying to predict what the stock market is going to react to that? It doesn't, because today's news has already been priced into the market. So the best thing we can do is to just keep up with the charts and then tell ourselves what we're going to do depending on what happens. So in other words, what we can see here is that on the weekly chart, a normal pullback would even go back as far as 1014 without really causing that much stress. If you just look at this chart and just take a look at it and say, and then mentally disconnect yourself from it, you would say, well, this is no big deal. This is just a standard pullback. The question you have to ask yourself is, at what point would I become more bearish? Now, this price could certainly pull back to 1014 without any trouble. In fact, it could pull back as far as about the 964 to 950 level on the S&P without doing that much significant damage. In fact, that would actually be a little bit healthier for the market to pull back into at least this level from 950 to 1000, somewhere in this area here, just to take a breather so that it can find more buyers and become a more sustainable rally that might last us another year or two before things perhaps tip over again. Now again, looking at the weekly chart, when we have a sell-off that occurs like this that builds these pivots, you can see it's stair-stepping down, and each one of these is an ABC or 1, 2, 3 signal. In fact, 1, 2, 3 sell signals. The market has a way of coming back up to revisit those 1, 2, 3 pivots, if you will. So it does look like, at least on the weekly chart, that we do have a day with destiny at around the 1200 level, and then everything after that is going to be on its own. The market's on its own after that point. So after that day with destiny is completed, we'll see what happens from there. But Right now it looks like we're just going through a standard weekly pullback, which is very healthy for the market to do, and we may see higher prices throughout the rest of this year. Now, what would cause me to reverse that type of thinking? It would be a slightly deeper pullback and then we come up to a lower high from here. So a deep pullback and then we come up to a lower high and then we fail from that point. That would cause me to think that we're going in a deeper monthly pullback. And at that point, again, we don't want to get too far ahead of ourselves. We're not trying to predict the next year. That's really useless and that's untradeable unless you can hold long-term positions with huge stops on them. So let's move into the daily chart and shorten our time frame up here and see what's going to happen over potentially the course of the next week or two. So after we've sold off here, we've been moving down in a wave-based structure, which is good because everything up to this point has been a V-bottom structure, and those are very unpredictable. So a wave-based structure gives us a little bit more clue about what's going on depending on how the waves unfold. Now each one of these rebounds has been on the order of 33 to 35 points. So the first one was 33 points. The second one off of last week's hammer has been 35 points, but if we look at this price action, it is not that enthusiastic. It's almost been kind of a grind up. So this is where we use our fib retracements to help tell us what's going on here. The first bounce failed at the 38.2% retracement right around 1100. So now we're going to drag this one down to the full swing, and you can see that the price has not even bounced up to the 38.2% retracement. And notice also that that 38.2% retracement lines up with the bottom of a very strong consolidation zone. So that's going to be overhead resistance for a while yet to be able to burst through that. What is looking likely on the daily chart is if it does find resistance here, what we'll see is we'll see a very quick sell-off into this to scare people to death, and this is where all the weak hand bears are going to jump on board, and the smart money is going to sit down here and buy this dip down here, and then you'll see a quick wave 3 rally coming up off of here. Now again, this could create a lower high that's up here. We don't care about that just yet. That's too far forward in the future. Now, just briefly looking at the Russell 2000, this is a small cap index. You can see that the price has now been able to climb above that 38.2% retracement. So it is showing a lot of strength in the small caps. So that's actually a pretty good sign. Now, because we're coming up on options expiration week, options expiration can have a factor in how the market closes for this week. So what we're seeing is in the S&P 500, the max pain level is at Spider 110 or S&P 1110, which is about 22 points north of where we are. So we might see a slight move higher throughout the week as options traders square their positions and hedge risk in doing so. And if we look at the IWM, which is the Russell 2000 ETF, we're seeing the same thing there at about a 62 level or a 620 level on the Russell 2000. Okay, really quick, let's go through our current positions and where we are. For the high probability iron condors, all we have left is an overhead call spread on the IWM about 69 with a protected butterfly in front of it. That's going to be literally impossible for the price to come up and attack this position. It should expire for max profit. We did have some put spreads down here at the IWM 57 strike, but we had a very small position. We thinned it out as the month went along, so we have a very small debit on there. So overall, we're going to keep a pretty healthy credit. So this is what we do. We actively manage risk in our favor. So thanks for watching, everyone, and see you next week. Now, before you go, if you're having troubles trading this market, it's because markets have become a lot more volatile and unpredictable over the last 4 years. But the way that we approach the market, we've been able to turn a profit the past 5 straight months and 15 of the last 17 for an 88% win rate. We're not looking for home runs. We're not going to bombard you with hype. We're just looking for conservative, steady income plays month after month after month. So if you're having troubles with this market, give us a test run. And don't forget, pick up your free report if you haven't already done so at our website, optionslinebacker.com. Just look for the free stuff tab.